Then the most important part after all this is actually volume. What do you mean by that? Now there are some candlestick patterns which is happening. There are some, which we're trying to know what exactly is happening. But if it is not substantially supported by volume, volume is nothing but the participants, whether they're buying, they're selling. It's actually the whatever participation is happening. Now if it is uh, substantial volume is there, then you believe that these movements are real. Otherwise it can be, the movement can be fake. Now how do you decide there is a substantial movement? Now definitely the current candle, whichever you are seeing, the movement, the bar movement you are seeing, the corresponding bottom you have to see. Now whatever is the movement, now here is an average. This is actually a 50 period moving average for the volume. You can apply a 50 period moving average for the volume, and any volume which is above this 50% mark is a serious. Now it's happening at the bottom. As you can see, it's happening at the bottom. There is actually a trend reversal, which is when I correspondingly see there is a trend reversal. Yeah, can you see that? Can you see that there is an inverse hammer which has happened, but there is a substantial volume which clearly denotes change in trend. Then again, when the up move begins, it is above average mark, above average, above 50 period average mark, which confirms that there is strength in the market. And then even all these major moves, yeah, as you can see here, there is no movement in the volume. Subsequently, you'll see there is no direction happening. When you see that there is a real direction which is happening, which is confirmed by the volumes here. Now, this is most important. So, unless there is a substantial interest of buyers and sellers participation in the market, you cannot confirm there is direction. So, understanding this volume is most important. Volume understanding is very much important. As you can see here, this is also a real chart basically. Now, you can see that the market is operating in a channel. There is not much of a volume. There is a decreased interest. You don't know. You actually don't know whether there is decrease or this is normal volume. You would never know this until you put a 50 period moving average. Then what happens? There is a breakout here. Can you see that it breaks the channel, and subsequently look at the bottom. There is an increase in volume, and subsequently there is a steady increase in volume. Also, it is corresponding with the big move which it has to make. Market has to make. Even when it is falling, as you can see, there is a falling market here also, which is actually corresponding, which is purely corresponding with the volume. Yeah, so volumes are most important. The volumes, understanding the volume, is market supported by right volume, is most important. Now I'm going to talk to you about moving averages. The moving average is a simple technical analysis tool that smoothens out the price data by creating consistent updated average price. The average price is taken over a specific period of time, like 10 days, 20 days, 10 minutes, 5 minutes. It could be any period, weekly, monthly, any chosen period it can be taken. Now, there are two types of moving average. One is a simple moving average, other is an exponential moving average. I can give you those formulas. There will be formulas to calculate simple, a moving average. But this, anything which is above these averages, there is a strength. Below averages, there is weakness in the market. There is not much of a rocket science behind this concept. There is not much of a rocket science here. It's very clear. What is a right moving average? What should we follow? We're going to learn this. I'm going to demonstrate to you using the live screen. I'm going to show you what exactly is actually should be a tool you should be using. We'll see that. But moving average is most important. We are going to study whether it's a short-term study, whether you are studying what is going to happen in the next 5 minutes, or whether you want to see what's going to happen in a month or so. These moving averages play an important role. Whether it is from as simple as a seven period, 8 period, it could be minutes, it could be whatever, it could be days, or whatever period from a 7, 8, as low as 7, 8, 5 until 200, 100 or 200, which is important. 200 is as good as 1 year. Remember, there are about close to about more than 200 working days. And this 200 actually covers 1 year period, which is most important. The last 1 year trend, it decides. And then there are so many other technical indicators. But here the point is, I'll not be stressing much on the stochastics, RSI, Bollinger Bands. Of course, moving averages you'll be seeing MACD. What I have seen personally in my life, I've spent over 20 years in this industry, and what I have seen, uh, these are not consistent in nature. The stochastic, RSI, there are limitations, a lot of limitations. But when it is used along with various other indicators, then it is very powerful. I'm going to explain to you how I'm going to use RSI, how I'm going to use, even moving averages, going ahead along with other indicators. So, but we will be basically understanding these technical indicators. I'm just going to brush through because these are one these are lag. Basically, this is not going to tell, this is more of an historical study, or rather I would say this will only be a post-mortem study. When I do this, it will be more of a post-mortem study than actually, well, it's not a lead measure. What's going to come up, what's going to happen, it might not exactly tell me. So I don't give much importance to this, but it's necessary that you know that these things exist and it can be used in combination. So these are some of the studies. Now, here I'm going to give you a definition of MACD, the most common, widely used indicators. Yeah, moving average, convergence, and divergence. Basically, it talks about the convergence, divergence. The formula is right in front of you. MACD is calculating by subtracting the 26 period exponential moving average from a 12 period exponential moving average. This is where you try to set the range, and then when there is a crossover, that is where the two different period, when it crossovers, it tries to give you a direction in the market. Yeah, that is how it is plotted. As we go ahead, you will see how exactly it is plotted here. As you can see this, I think at the screen is there is a blink. You can see the circle here. There are two, basically there are two moving averages which is plotted, and whenever there is a crossover which is actually corresponding with an action which is happening here. Yeah, the definition is again given here. Does it work in all situations? Does it work in all the conditions? I cannot really vouch by it, and it's not consistent always, but it has to be used along with various other indicators. Then it can be a good tool, a nice tool. But my idea is to actually introduce you to this. Now there is another concept of I would like to introduce you to another concept of an overbought and an oversold in the market. What happens when there is a lot of buying and then there is an exhaustion? That is where you actually see that there is actually the market is overbought. There is not much of a strength to go further on. That situation is overbought. What is an oversold? The market, there is so much of selling which has happened. There is no strength actually for the markets to move up, but there is no strength even to go further down. That is where the situation is overbought and oversold, and that is typically we understand it in two different, the percentage. That's overbought and oversold is understood between the range of 30 to 70% of RSI. That is relative strength index. Is calculated using an average price gain and losses over the given period of time. The default period is 14 periods with value bounds from 0 to 100. For example, RSI may show reading above 70 for sustained period of time. Yeah, it can show for sustained period of time, indicating that the security is overextended, yeah, to the buy side. Now, let me tell you, the markets can remain illogical and insane beyond I and you can remain solvent. Yeah, we will be insolvent, but the market can be illogical. So why? RSI is an important tool. Basically, when it crosses the mid area, the 50% area, if it corresponds to the trend, then only it's a good signal. If the RSI is above 51%, and then you see there is actually, even it corresponds with the right kind of candle, then you can see there is a buying interest, also supported by volume. Now this is where I would like to show you. As you can see here, markets hit the peak mark here, but there is a substantial up move, but it kept saying for large period that it is overbought. Yeah, there were some minor points at which it came to the midpoint and it kept going back, but it's not comprehensive, it's not complete in nature, but it is only a part of the signal. That is why, even I don't personally, it's not my choice that I don't much go with the RSI, but it is just for the understanding I'm sharing with you the concept of RSI. Here is the formula. I think you can take a closer look. You can actually take a screenshot. This is the formula. If you're academically interested or if you really want to work, but these days with a lot of technology advancements, these are readily available. These are ready available tools. Not only this standalone tool, it is actually merged and it is actually being used. Several indicators are used collectively, and then you get the final output. End of the day, it's action which you would like to take, and that is possible with this kind. I'll be introducing to them as we go ahead. Now again, the stochastic is another way. These were amazing discoveries which people made. There are fast stochastics and there is a slow period stochastics which is actually formed. But as I told you, this is not complete or a comprehensive based on which you cannot make your immediate buying and selling decision. You won't be able to make an immediate decision. But these small small compartments of study which falls part of a big study. So all this combined together actually can give you a great output, which I'll be telling you as we go ahead. I'll be introducing you to some of the softwares of the modern tools which will actually use on this to give you an outcome. So only for the academic interest, you just have to know that the this is being studied. Again, this will have a range. This is also studied in ranges. Yeah, stochastics. Again, there is fast and slow. Now I move to the trends. Basically, market trend. A trend is actually a straight line that connects two or more price points. Basically, there has to have 2 points, and then you extend that line. That will be the future, act as a support or a resistance. If it's at the bottom, it's a support. If it's at the top, it acts as a resistance. The trend lines as technical analysis is built on, it's an assumption that the price top, the use of trend line is important for both trend identification and confirmation. Is it following the channel? Then it's a confirmation. Now there can be uptrend, there can be downtrend, there can be sideways trend. Now, what is key to be successful in the stock market? Let me tell you, the key to be successful in stock market is trend following. See, against, you might be in a very adventurous person. I know I can swim against the tide in the ocean. Yeah, that is fine, absolutely fine. But it can be very tedious. You're not going to really reach your destination if you're swimming against the tide. You can only, it is only a moment of bravery. At the end of the day, you reach nowhere. So similarly, even in the market, the best and the smartest thing to do is actually follow the trend. Yeah, following the trend, which means you don't first of all, decide the trend, or you don't make the trend. First of all, you don't make the direction. You should know that there's nothing much, hardly anything in your hand. You don't make the direction. Now there are bigger players, there are operators who actually make this direction. And if I'm able to identify this direction, if I'm able to move in that direction, I'll be a successful trader end of the day. So I have to understand how quick I understand the trend and I make my moves there, makes me a smart trader.